In 2023, JP Morgan Chase generated $49.6 billion in net profit. The same year, 130 million Americans paid that bank $35 overdraft fees on a transaction that cost the bank 30 cents to process. Same institution, completely different realities. Most people think about banking from the wrong side of the glass. The question has never been which bank you use. It's whether you own one. That world has 5 levels. Let's get into it. Level 1. The community bank. Assets $100 million to $1 billion. Net income $5 million to $10 million per year. This is where bank ownership begins, and where most new owners quickly discover the gap between what they imagined and what they actually bought. A community bank takes local deposits, makes local loans, and earns the spread between what it pays savers and what it charges borrowers. That spread runs 3% to 4%. On a $500 million loan book, that is $15 to $20 million in gross revenue before staff, compliance, technology, and regulatory examinations eat most of it. Net income lands between $5 and $10 million for a well-run institution. Here's the honest take. Owning a community bank is not owning a money machine. It is owning a heavily regulated utility with thin margins and an aging customer base. The FDIC examined your institution last year. The OCC will examine it this year. You cannot decide to lend more aggressively because you want better returns. A regulator will tell you otherwise. The competition has shifted underneath you. 10 years ago, you competed with the regional bank down the road. Today, you compete with Chime and Apple Pay, companies with no branches, no legacy infrastructure, and no interest in your local market. The 23-year-old opening her first account in 2024 has never set foot in a branch. She never will. The core customer is aging out. The institution knows it. Who owns this? The founding family whose grandchildren now sit on the board. The private equity group that acquired a struggling institution in 2008 and has been collecting steady dividends ever since. The local businessman who wanted control over credit allocation in his market and knew a bank charter is one of the hardest licenses in America to obtain. The upgrade trigger is scale. Compliance cost per dollar of revenue eventually becomes unsustainable. You either grow through acquisition or you sell to Level 2. Level 2, the regional bank. Assets $1 billion to $100 billion. Return on equity 10% to 15% annually. This is where owning a bank starts to feel like owning a real business. A well-run regional bank at $10 billion in assets produces $100 to $150 million in net income per year. Revenue streams multiply. Commercial lending, consumer banking, mortgage origination, wealth management. You are no longer managing a bank. You are managing a financial holding company. The acquisition strategy becomes the product. The best regional bank owners spend less time managing their existing institution and more time identifying the next community bank, whose owner is 71, whose children have no interest in running it, and whose $400 million loan book slots cleanly into the existing portfolio. That deal closes at 1.2 times book value. Integration takes 6 months because the acquiring bank has done it 11 times before. That is the compounding mechanism. Each acquisition makes the next one cheaper to execute. The infrastructure is already built. The compliance team is already staffed. The only variable is price. Here's the honest take. This is where the upside becomes genuinely attractive and the downside becomes genuinely serious. Silicon Valley Bank had $212 billion in assets in January 2023. By March 2023, it was seized by regulators. The fastest bank failure in American history. At this level, the downside is not just losing your investment. It is a federal receivership and your name in every financial newspaper in the country. The concentration risk in their bond portfolio, combined with a deposit base that moved faster than any historical model predicted, ended a 40-year institution in 48 hours. Level 3. The National Bank. Assets: $100 billion to $1 trillion. Return on equity: 12% to 18% annually. This is where a bank stops being a financial institution and starts being infrastructure. US Bancorp. Capital One. PNC. At this level, the checking account is the entry point. The mortgage is the retention tool. The credit card is the margin engine. Every product is designed to deepen the relationship until switching costs make leaving irrational. As an owner, the moat you are sitting on is not the product. The moat is the data. 20 million complete financial profiles. Income, spending patterns, credit behavior, life events. That data compounds. Every transaction makes the next prediction more accurate. Every product a customer adds makes them harder to replace. You are not selling financial services. You are building a switching cost so high that rational people never leave. Here's the honest take. At this level, ownership is almost entirely abstracted from the institution. The largest individual shareholder of US Bancorp owns roughly 1%, worth around $600 million. But 1% does not give you control. It gives you a dividend check. The management team runs the bank. The owner collects the return. The manager has more operational power than the owner. That inversion is the defining characteristic of national bank ownership. You own the machine. You do not operate it. Level 4. The global, systemically important bank. Assets: $1 trillion to $4 trillion. Return on equity: 14% to 20% annually. This is where a bank stops being a business and becomes a geopolitical actor. JP Morgan, Goldman Sachs, HSBC, Bank of America. These are the 30 institutions designated too big to fail, not as a metaphor, but as a policy position. In 2008, the US government injected $700 billion into the financial system because allowing these institutions to collapse would have caused a global economic contraction no government was prepared to accept. That implicit sovereign guarantee is the most valuable asset on their balance sheet. It does not appear on the balance sheet. Every counterparty in the world prices it in. JP Morgan's Treasury Services division processes $10 trillion in transactions per day, more than the annual GDP of every country on Earth except the United States and China combined. The investment banking division sees the deal before it is announced. It sees the stress in a balance sheet before the quarterly filing. It sees the capital raise before the press release. That information advantage, legal, structural, and permanent, is what the GSIB actually owns. Everything else is the product built on top of it. Here's the honest take. At this level, ownership has become philosophical. No individual controls a GSIB. The institution is too large, too complex, and too systemically important. The bank owns itself. Everyone else holds a claim on its earnings. Level 5. The final level. The bank that banks the banks. Forget owning a bank. At level 5, you don't own a bank. You are the bank. The Federal Reserve, the European Central Bank, the Bank for International Settlements in Basel, the Central Bank of Central Banks, whose 63 members represent 95% of world GDP. These institutions are not owned in any conventional sense. The power is absolute. The ownership is nominal. When the Fed raised rates from 0.25% to 5.5% between 2022 and 2023, the monthly payment on a $500,000 mortgage increased by $1,400. No shareholder voted. No customer was consulted. 7 people, 8 meetings a year, 1 number. And the entire cost of borrowing on Earth adjusts around it. The private equivalent is BlackRock, $10 trillion in assets under management. Its risk platform monitors $21.6 trillion for external clients. When BlackRock's models flag a bond as risky, pension funds in 30 countries adjust simultaneously. That is not a bank. That is the operating system that banks run on. At level 5, you do not set the price of a loan. You set the price of money itself. Banking started with a simple idea. I have money I'm not using. You need money you don't have. I'll lend it to you for a fee. And somewhere between the community bank on the corner and the Federal Reserve in Washington, the product changed. A community bank owner and a central bank governor are both doing the same thing, controlling the flow of money. One controls it for a county, the other controls it for a continent. The community bank owner approved the mortgage on the bakery that's been on Main Street for 30 years. The central bank governor has never met the bakery owner. But when he raises rates by 0.5%, the bakery's line of credit costs $800 more per month. It is not personal. It is structural. Every other industry sells you a product. Banking, at the highest level, sets the terms under which everything else is bought and sold. The bank was never the point. Whoever controls the cost of money controls the cost of everything.